Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. We're still having some StreamYard issues, so we do just stick the picture in the corner and don't take the risk of the platform shutting down. So that, I think, is going to be a couple more days. Maybe by Friday they'll have it all figured out, but it is on the StreamYard side of things. So with that said, let's jump right into it. JP Morgan is going to be announcing earnings next week. To me, that's the start of earnings season. They're announcing on the 15th before the open. I like the deal maker stocks, and JP Morgan is one of them. There's more talk about mergers and acquisitions. There's more talk about IPOs. There's more talk about regulations easing, and on top of it, the yield curve is doing just fine. The 10 versus the 2 is finally back in line, and it's getting a little bit better. It's not the best in the world. If we got some short-term interest rate, if we could get the Fed to cut on the in the shorter term, going into the end of the year, that should kind of help out that yield curve a little bit, you would think. Not always 100% sure exactly what's going to happen if the Fed does cut rates, but the probability based off of the futures of the Fed cutting before the end of the year has increased dramatically over the last month, and obviously you got a lot of pressure from the White House. So with that said, I like bank stocks just in general. Buying the XLF if you were interested in that, or picking your favorite stock and looking to trade that stock. What just so happens that JP Morgan is the first one that's going to announce, and then there's going to be 4 or 5 right after that, usually. And I just want to get long JP Morgan. So here's how I want to do it. First of all, I always like to start out by looking at the expected move if I'm doing a trade around earnings. So with that said, implied volatilities are up a little bit, but they're not ridiculous by any means. The expected move is $11.70 at the midpoint right now. That's right around 4%. Looking at the strikes, the nearest strike that would put you at is the 295 strike. And I always like to double check that, because if you look over here and you look at the delta is going to be somewhere around 20. So 297.50. Did the market? Yeah, market just jumped up a little bit. So expected move is right in between these two numbers. And usually the delta is going to be fairly close to 20, about an expected move away. Translate that, it's always a little bit less than the 1 standard deviation move. The implied volatility going out to the earnings is at 32%. So like I said, this number isn't that large. The expected move isn't that large. I expect it to be a little bit more bullish than bearish, but one of the things that does make you nervous, if you go back and look at some of the charts, is the fairly strong move that the financials have had. A lot of times in big stocks like this, when you get strong moves to the upside, they take the earnings as an opportunity to try to sell off the stock the day after earnings, at least. So I'm going to go out further in time, and I'm going to go a little bit in the money, and we're going to look at doing the August 23rd expiration. Now, in this instance, remember the expected move is right around 295 or so. The August 23rd expiration goes out 23 days. The market right now is at 285.95. And so we'd be well within the range if we say that we're going to buy the at the money and sell something about a 1 standard deviation move away, which would be the 300 strike. But you can also look at buying the 280 strike. The only difference here is that you're talking about quite a bit more change, a little bit better break even, but a little bit more change to put up for the trade. But then again, you also have a wider spread. So you got potential for more max gain on the upside. So I'm going to actually stick with that. I usually like to do the cheaper one when I'm looking at Options Guide TV, just to try to keep the risk within line if we're looking at a 1-by-1 trade. But here I'm going to look to buy the August 1st, 23 days away, 280 call option. That's adding it to the straddle down there. And then sell right at the 1 standard deviation move, actually just short of it. I just want the premium, the 222 strike, giving us a 20-point wide spread and a decent risk reward, right? We're risking $8.47 to be able to sell this for a potential $20 in this instance. So a little bit more favorable risk reward than possibly doing a short spread, which I don't actually mind that here. If you didn't mind owning the stock, I don't mind selling a short put spread. I would do it a little bit closer, though, if I was doing that. But this is a pure speculative play around earnings, giving the stock a little bit of time to run. I do think that talking about forward outlook as far as the conference calls are concerned, I think they should be good in the banks. Numbers I expect to be fairly decent, considering, like I said, once again, what has happened with interest rates. The guidance is, I think, something that could drive the stock higher. The stocks in the space, especially the deal makers, Goldman Sachs, JP Morgan, even BlackRock is an interesting stock this time around. But it's a very expensive stock. So with that said, here's going to be the paper trade. I'll send this to the what if calculator. Remember, it's on the open on the 15th. I don't mind buying it now. You're paying a little less juice. Implied volatility will probably increase going into the trade. But this is it's a speculative trade in that we're doing it around earnings, but it's mainly because I just want to be bullish on some of the banks. And we'll probably do quite a few of these as we head in over this week and at the beginning of next week as we head into these earnings. I just almost want to do our own little bull call spread ETF in the banks heading into their earnings reports. They're the ones that's the industry that hasn't been talked about a lot, doesn't get the respect that the semiconductors, with NVIDIA hitting $4 trillion market cap today. And but they've been quietly doing very well. So here is the official paper trade. We're going to go out to the August 1st expiration. We're going to look to buy the 280 strike call and at the same time sell the 300 strike call. The expected move on the underlying stock is about 12 points. If the market did move against us a little bit, we could look to adjust it. We could bring the 300 strike call down a little bit and maybe go down to the 290. And so that would be my hedge on the trade. If the market didn't continue up, we got a decent update today, right? We're up about 0.5% at $1.85. So not a bad update by any means. And I do kind of expect that we might see that going into the earnings report, especially in JP Morgan. Okay. So if you have any questions now, last Monday, we did, well, I guess in anticipation of markets kind of staying stable on Monday, but then we had news headlines again. We an adjustment in the tariff policy once again. Not a lot of clarity in that policy, and as soon as that news hit, we had the market go down. Our path of least resistance, in my opinion, on Monday was to the upside. Markets went down, but they came back. But it was at a crucial time that it happened. So what we did was an open wing butterfly. So if I look at the SPX, and let me just move this chart over here, and we'll go back to Monday, right at 11:15. So this is when when we were talking about the trade on the show, right about right here. On this 15-minute bar. So 62.40 was our center strike. We didn't get that long until that press release came out about the tariffs. and that was 12.15, and then we had to drop precipitously down to 6,227. All right. I would have got out of the market at that point in time, and I personally did, and I lost $1.50 on my spread, on my open wing butterfly spread with calls. Now, interesting enough, in that if you stayed the course in this trade, you would have done just fine at the end of the day. So the market then continued on down. And my warning is, you never want it to get outside your strikes. And it hung around the 620 level all the way up until about 2 o'clock. The fact that it was there at 2 o'clock, you should definitely have gotten out. I looked at the quote. It was trading down about $3. We put the whole trade on for $9.80, and it was trading for about $6.20. So it was actually a little bit more than $3 at that point in time. And if you didn't get out there, and then you probably panicked, and you probably sold somewhere in here, which wasn't good. Well, then the markets were kind of like, well, I guess this is okay. We're still talking about trade deals. Market comes back, and it settles at 4 o'clock, or at 6:16, which would be on the close. It settles right about right here, actually, right at the high. So I looked at it on the close, and I took a snapshot of it, and we would have been at break even. We would have paid about $9.80 for it, and we could have sold it for about $9.80. It was right at the tip top of this candle that it closed at. If you didn't follow the rules, you would have been okay. You obviously had opportunities when it came all the way back to the right where we started at, almost for a minute, 640 level. If you didn't get out at that point, and I'm sorry, here's where the close was. Yeah, right here, 629. I'm pointing at the wrong candle, but this is where the close was. Yeah, 620. Yeah, because it was $6,229 and some odd change, very close to the close when I took the screenshot of the open wing butterfly. And like I said, you would have got out at break even on that trade. We had the 620 long call. We paid $9.20 for it, but you would have panicked and it got out here. This was the news event that should have got you out of the market. When this 15-minute candle, it was too soon. It was too soon after our trade. And yeah. Any questions on it, by the way? Go ahead and give me I see one comment. Okay. As soon as the news hit, right, Anthony? Anthony got out of the trade. Yeah, that just made sense. Okay, I apologize that I was looking at the wrong candle there. But yeah, interesting that it came. Look at that 15-minute, that last 15-minute candle at the end of the day was very strong going into the close. All right, that was the SPX trade. I still don't mind that trade. I still don't mind doing a one-day SPX butterfly. I still feel like we got chop in the marketplace. The VIX has obviously came off a little bit, so we keep trying to set new highs. We're at 1647. So it's going to be fairly expensive to do the volatility trade, even though this is 30-day vol. One-day vol really is what matters the most, but this is what we have access to here right now. But you can also just look at SPX options and look at chart where the volatilities are at when you're doing those trades. So if you're doing it religiously, or at least 2 or 3 times a month, because you feel like the markets are going to just chill for a minute, then chart where the vols are at. I think it's very important, and chart relative to the price. And you will notice that it makes a huge difference where implied volatility is at when you do those trades. And yeah, not too much more to say except that earnings season is coming. So JP Morgan, that is going to be our trade. A little bit more, in my mind, a little bit more wanting to own JP Morgan as opposed to speculating on their earnings report. I don't mind selling a put spread either in this instance. I think that the numbers are pretty good in this range as far as risk reward. If we sold something at the money right now, so this is you're risking $8.20 minus $8.47. You're risking $8.47 to make $11.53. If we do this trade, buying the 280 strike. Let's see what happens if we do the short put spread with the same expiration. So let's get rid of this trade. And let's look at selling the 280. And we did 535. Even if we go down to here, that's $2. That's one standard deviation, or the expected move approximately away. Guess we'll do 20 points just because we did. That's what we did on the long call spread. $4. Yeah, that's not bad. You're bringing in $4 at 20 points of risk. So four with $2,000 worth of risk. Upside is 4. Max risk is 16. Or you pay $8, which would be your max risk, with the potential, if you do get the move to the upside, to make $11.53. I don't mind either of these trades. But that's going to be it for this edition. Unless you guys got any more questions. Short and simple, and then we'll get into a little bit more earnings trades. Do you want to look at another open wing butterfly? Would definitely lean to the upside. I think there's a lot of euphoria in the marketplace with NVIDIA hitting the $4 trillion market cap. All right. I'll let it go. So here's the official paper trade. We're going to look at this one. We'll see this one on Friday, and then we'll head into earnings next week. Thanks for stopping in. We'll see you this Friday at 11 a.m. Eastern time for the next edition of Options Guide TV. And check out the Tradier Hub, hub.tradier.com. If you haven't set up a profile yet, please do so. Have access to all the great speakers for free that Tradier sponsors. And check out the Hub. Hope to see you in the Hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.